Dustin Tibbits here, financial advisor with Jazz Wealth Managers, and today we're going to answer a question. A client wants to invest in a seasonal rental property in Montana, and no other advisor can find out the answer to this as quickly as we can. So let's take a look. We're going to go over to their scores. So we call this the DOE score here. We've got their total net worth, their investments. We have their DOE score, which just kind of their fun way to sort of gamify your financial life. We've got all of their financial metrics all in one shot here. Now, they want to take about $100,000 and put it as a down payment towards a seasonal investment property. We've talked a little bit about how this investment property will generate returns, what types of returns they will expect from rental income. And so they say, well, can I do it? Well, really quickly, we can come in here and see, oh my God, you're really behind on retirement. Is that a problem? Maybe not. This client in particular has a lot of equity or business equity in what they've built as a small business. So their retirement has been a lack of a focus. We give them a tiny bit of a pass on this one. However, we've already addressed how to focus on that. Their debt to income ratio is really, really low, which is awesome. So for the remaining portion of the property that they're going to purchase, which will be financed, we know that we can assume that the mortgage company will have no issues with this. They have a very low debt to income. Total liquidity, they've got essentially 24.7 months of dollars that they can take out if, it hits the fan and they need money for liquidity to meet their expenses. Well, that means that we can actually look at some wealth building opportunities here. 54% of all their dollars that they have in terms of their liquidity could be used towards wealth building. Well, they want to build wealth. They want to buy their rental property. So we look inside of this and we go, hey, you've got a lot of money in liquid assets. Can we take from those liquid assets? We'll go over to their balance sheet and find out that most of it's in just a traditional brokerage account. Okay. So they could take $100,000 from here. We're going to talk about that a little bit. We want to make sure that they're not tied up in long-term capital gains or any issues like that. We could also talk about the idea of doing what's called an asset-based line of credit in the event that they have, let's say they own Verizon for like 20 years. That would be weird for these people. They're 43. But let's say that's the case and they have a huge long-term capital gain. Could we borrow against their account to then go finance the down payment on the property? Would that make sense? I don't know. I'm just pointing it out. The point being that since most everything they're doing is almost on track, yes, we can focus on building wealth now. They have achieved a certain point in their lives where this makes sense. It can work for them. We can add to their debt with the remaining financeable amount, which is about $620,000 to their debt and not make a dent there. We have plenty of liquidity by taking the money out of their account for the down payment. We bring their liquidity down to about 16 months, which is still really, really great. Their efficiency score, which means how efficient are they being with all of their dollars, is actually almost perfect. So no issues there. And inside of their retirement accounts, they are invested perfectly, meaning they don't have junk investments in a Roth IRA. They don't hold municipal bonds in a Roth IRA. They're not holding some really high dividend paying ETF in their brokerage account. They're really focused and being efficient with how they allocate their dollars to the investments relative to the accounts that they have. So really short and a simple video here. Can these people focus on putting $100,000 in of their cash, their liquidity, towards the down payment on a rental property? Yes, I'd actually give that a thumbs up. I have no issues with that. The one thing while we do that, I'm going to go back and I'm just going to pick on them a little bit and go, hey, while we're doing this and I have your attention for a second, we're going to make sure that we address your pre-tax score, meaning you have 100% of your extra retirement dollars in pre-tax accounts. Based on your income and everything you have, we need to split that up into about a 70-30 split. Exactly what is needed for them at the moment. That is the focus of our DOE score here. We have conquered this question for our clients. If you're a client and you want to know whether you can have something done for you and we can analyze this for you, let us know. This is brand new for us here at Jazz Wealth. We built this all ourselves and it's constantly improving. If you're not a client of Jazz Wealth, what if an advisor could not only manage your retirement investments, but also answer any financial question that you had as it changes? I had a baby. Can I afford to put money in their 529? Should I use a custodial account? Hey, I'm deciding on starting my business, expanding my business, investing in some other friend's business, right? What can you do? And is it possible with the dollars that you have? We're going to be the first advisor, as you've seen, that can actually do that for you. Analyze and strategize on your life with every single dollar you have. Super excited about it. We call it the DOE score, actually, because we say get your dough straight. So I hope you'll check us out at jazzwealth.com. Hope you learned something here today. Thanks for watching, and let's get your dough straight. Go to jazzwealth.com. Let's get you set up. Move from the big boys. Those big boys aren't helping you out with anything anyways, and they're charging you likely more than we're charging here. It's on our homepage. You can check it out whenever you get a chance. Thanks for watching. Enjoy the rest of your evening. Adios.